Hello friends, today's topic is clubbing provisions. We will be studying the background of clubbing provisions wherein the general provisions will be discussed, where the basic crux is the situation in which the income of another person is clubbed in the hands of the transferor. So what is the general background? What are the general provisions will be discussed in this subtopic. Now friends, this subtopic name is background. We will understand the background of the clubbing provisions wherein income of another person is clubbed in the hands of the transferor only if the intention of the transferor is to shift the tax burden. The intention of the transferor is to shift the tax burden to the transferee in such a way that the tax liability of the transferor gets reduced, and also in the hands of transferee nothing will be taxable given that the income of the transferee is less than the slab benefit. So this is one of the general example, in which we can understand the intention of transferring an asset by the transferor to the transferee, right? So basic intention of the transferor is to reduce his tax liability, correct? And that is why any asset, it could be cash, it could be any movable property, immovable property, which a transferor is transferring to his relative, you can say. Majorly the person covered over here are relatives, and here the meaning of the relative is brother, sister, any spouse, or you can say not spouse, any lineal ascendant or descendant. I meant any lineal ascendant or descendant of the individual, and also including spouse of the individual. So definition of the term relative has been borrowed from section 2 clause 41, and relative includes brother or sister of the individual, spouse of the individual, and any lineal ascendant or descendant of the individual. Fine. So any asset is being transferred to relative of the individual in such a case if it is proved, if the transfer denotes that the tax liability burden of the transferor is being reduced. In such a case, the income of the transferee in respect of that asset, will be clubbed in the hands of the transferor. So this is the basic background of clubbing provisions, clubbing of income in the hands of the transferor. And the income which is clubbed is in respect of the asset which is being transferred to the transferee. Correct? On your screen, friends, these are the sections which has been mentioned over here. Section 60 to 65. In this subtopic, we will be covering section 60 to 63, wherein a general background of the clubbing provisions has been provided, and specific background, if we ask, is covered in section 64, where any asset transferred to a spouse, any income of minor child, income from property transferred to HUF by the individual, right? These are all covered in section 64. And in the case of section 65, liability ultimately lies with the transferee, which is coming from section 65. In case any notice is issued, notice of scrutiny can be issued by the assessing officer to the transferee, and in such a case, transferee shall be liable for any tax liability which is incurring out of such transfer of asset. So we will be discussing this in detail at a later point of time. For the time being, we are discussing section 60 to 63 in this subtopic. So friends, first, transfer of income. Section 60, transfer of income where there is no transfer of assets. Meaning, let's take an example. Mr. A, who has rented out his property to another person, and he is in receipt of rental income. He is about to receive the rental income. At the time of agreement, what Mr. A did was he agreed with the tenant. Tenant should pay the rental amount to wife of Mr. A. Though the asset is in the name of, though the property is in the name of Mr. A, just to decrease his tax liability was cut start. What Mr. A has agreed with the tenant is the rental income should go in the bank account of Mr. A's wife. As Mr. A's wife total income is less than the slab benefit, the rental income that will be received will be reduced. The tax payable on the rental income will be reduced in the hands of Mr. A's wife. Instead, if it is taxed in the hands of Mr. A, then it will be taxed at maximum marginal rate, which is more than 30%, including surcharge and education cess. So, just to decrease the tax liability, just to decrease the overall tax burden, Mr. A has entered into arrangement with the tenant that rental income is to be paid in the hands of A's wife, correct? And this is an example of section 60, friends, wherein there is transfer of income where there is no transfer of asset. In our example, Mr. A continues to hold the asset. Mr. A continues to hold the asset. House property is still in the name of Mr. A. However, due to such an arrangement, rental income is going in Mr. A's wife account in the hands of Mrs. B. Sorry, in the hands of Mrs. A. The rental income is going, and accordingly it is offered to tax. In practically, it is offered to tax in the hands of Mrs. A. So, just to avoid such an arrangement, what clubbing provision says is such a rental income will be clubbed in the hands of Mr. A, will continue to be clubbed in the hands of Mr. A. So friends, section 60, transfer of income without transfer of any asset. In such a cut start, in such a case, clubbing provisions would apply. Section 61, revocable transfer of assets. So friends, here we will see, cut start. So friends, here you will see this term being used often, wherein revocable, irrevocable. Revocable is something which can be cancelled at a later point of time. You are entering into an agreement wherein Mr. A has opened a trust wherein he will deposit the amount in a trust, and that will be utilized for the benefit of, you can say, a certain section of society. It will be utilized for their benefit. So beneficiary is a certain section of the society, and Mr. A is transferring certain amount to a trust. Now, if Mr. A says that the benefit is revocable, right, wherein he is saying that I will transfer certain assets to the trust, but ultimately after, you can say, 6 to 7 months, this benefit accrual is revocable, is cancelable, and ultimately the benefits will flow to me and not to certain sections of the society. So here you can see that though the trust has been created for the benefit of the beneficiaries, however, the conditions are revocable, wherein after 6 to 7 months, the funds or the assets will be taken back from the trust and it will be no more available to the beneficiaries. So, in such a case also, it is an example of clubbing provisions wherein if you are transferring certain amount, certain assets to a trust, then ideally it should be irrevocable, meaning you should not have any right on such assets. You have transferred the ownership, you have transferred the right over such assets. But where there is revocability involved, wherein it can be cancelled at a later point of time, then in actual terms, such an ownership or such a right, in practicality, it hasn't been transferred to actual beneficiaries. So friends, if there is a clause of revocability in transferring of assets, then in reality it is not an actual transfer, and in terms of clubbing provisions if we see, let's start, and in terms of clubbing provisions if we see, then from the viewpoint of clubbing provisions, such a transfer of assets will be continued to be taxable in the hands of the transferor. Section 62, transfer irrevocable for a specified period. So friends, in an example, the transfer was irrevocable for a period of 6 to 7 months and thereafter it was revocable. So our example was a combination of revocability and irrevocability, wherein for a period of 6 to 7 months, the transfer of assets was irrevocable and thereafter it was revocable. So section 62 also will be taxable from the viewpoint of clubbing provisions. It will fall under the net of clubbing provisions, and accordingly any income from such an asset which is revocable or irrevocable for a certain period of time, in such a scenario the transferability could start. The transferability of such an asset, in reality it is not an actual transfer, and accordingly income from such asset will be taxable in the hands of the transferor. And friends, section 62 is nothing but it defines what is transfer and what is revocable transfer. Correct? On your screen, these are the exact wordings of the provisions. Section 60, transfer of income where there is no transfer of assets. Section 60, in this we took an example of rental receipts in the hands of Mrs. A. Also, the asset hasn't been transferred to Mrs. A. Mr. A continues to hold the asset. However, he has entered into arrangement with tenant wherein amount is paid, wherein the rental income is paid in the hands of Mrs. A in the bank account of Mrs. A. Such an arrangement, in such a case, the clubbing provisions would continue to apply. So friends, all income arising to any person by virtue of a transfer, whether revocable or not, and whether effected before or after the commencement of this act. So income arising to any person by virtue of a transfer, right, shall, where there is no transfer of assets from which the income arises. There is no transfer of assets where the income arises, shall be chargeable to income tax as the income of the transferor and shall be included in his total income. So friends, it shall be chargeable to income tax in the hands of the transferor. So you will have to see substance over form concept, wherein legally you can say, legally also in this case, Mr. A is the owner of the asset, only the arrangement is such that in the bank account of Mrs. A, the rental receipts will be credited, and if you see prima facie, if you see the bank statement of Mrs. A, you will be like, okay, as per the bank statement, Mrs. A is in receipt of rental receipts, rental income, then accordingly it should be taxed in her hands, cut start, should be taxed in her hands. However, in reality, Mr. A continues to hold the asset, and accordingly, as per section 60, clubbing provisions will apply, wherein whatever is appearing in Mrs. A bank account as rental receipts will be clubbed in the hands of the transferor, will be clubbed in the hands of Mr. A, right? Revocable transfer of assets, again clubbing provisions would apply. All income arising to any person by virtue of a revocable transfer of assets shall be chargeable to tax as the income of the transferor and shall be included in his total income. So in case of revocable transfer of assets as well, it shall be chargeable to tax in the hands of the transferor. Section 62. Transfer irrevocable for a specified period. Subsection 1 of section 62. The provisions of section 61 shall not apply to any income arising to any person by virtue of a transfer by way of trust which is not revocable during the lifetime of the beneficiary. So in our example, if the trust benefits, if it was irrevocable during the period of infinity, I mean in our example we took that example that we discussed was cut start for a period of 6 to 7 months. The project cannot be revoked, the benefits cannot be revoked, right? If it would be such that the benefits of the trust are irrevocable, cannot be revoked for a period of infinity, in such a case, section 61 wouldn't have applied. So by way of trust which is not revocable during the lifetime of the beneficiary, and in the case of any other transfer which is not revocable during the lifetime of the transferee. If it's a trust, then beneficiary will come. If it is not a trust, then the person to whom it has been transferred will be transferee. So not revocable during the lifetime of the beneficiary or the transferee. Second, made before April 1961, which is not revocable for a period of 6 years. And it is before 1961, practically it may not have any relevance. However, if it is before April 1961, then the period of revocability is 6 months, is 6 years, wherein after 6 years, even if it is revocable, then also section 61 won't apply, right? And meaning it won't be considered irrevocable for a specified period, provided that the transferor provided that the transferor derives no benefit or indirect benefit from such income in either cases. Obviously, no benefit should flow to the transferor either directly or indirectly in any way, where he has created, for example, a trust for the benefit of the beneficiaries, then the benefit then the benefit which should flow to the transferor should be nil. There should be no benefit which should flow to the transferor, whether directly or indirectly. So subsection 1 states exception to section 61, wherein if the transfer of asset is irrevocable, then nothing will be taxable in the hands of transferor. Notwithstanding anything contained in subsection 1, all income arising to any person by virtue of any transfer shall be shall be chargeable to income tax as the income of the transferor as and when the power to revoke the transfer arises, and shall then be included in his total income. Correct? So subsection 2 is nothing but if transfer of assets is revocable after a certain period of time, then it will be continued to be taxable in the hands of the transferor. It will be taxable as the income of the transferor as and when the power to revoke the transfer arises. I mean, a classic example that we can take is from Bollywood movies wherein the uncle and auntie takes care of a child who is a minor, and it's like once he will be major, after 18 he will be eligible to a certain property of his parents, and obviously his parents are no more, so they have created a trust. Parents created a trust for the benefit of the child, wherein after attaining major, once he is more than 18 years, he will be eligible to the property, right? So in this case, it's like obviously after attaining major, the child would have rights to transfer a certain portion of the property to uncle and auntie and so on and so forth. But here, if you would say, if the parents would have created a trust wherein they would have right to revoke the benefit to their child, then the tax from the taxability point of view, the income would have continued to be clubbed in the hands of parents. It's only that if a trust is created for the it's only that if a trust created for the benefit of the beneficiary is irrevocable, wherein no other benefit is flowing to the transferor, then it can be said that a true transfer has been made. Then it can be said that there is transfer of ownership or transfer of right in the asset. If there are any provisions of revocability at any point of time, then it is not an actual transfer, and in such a scenario, the income from such an asset will be continued to be clubbed in the hands of the transferor. Right, friends? Section 63, transfer and revocable transfer. For the purpose of section 60, 61 and 62 and of this section, a transfer shall be deemed to be revocable if it contains any provision for the retransfer directly or indirectly of the whole or any part of the income of assets to the transferor. So as we have discussed, the benefit that should go to transferor should be nil. Even a part of the income should not be transferable to the transferor. So there should not be any provision for retransfer to the transferor, whole or any part. This is also important. So in an example which we took of a Bollywood movie, if parents would have told that the benefit, a part of the benefit will again go to them or to certain section of the society for their benefit, you can say. For parents' benefit, let's say her mother is still living, and in such a case, if the transferor says that part of the benefit from the trust will go to mother, will go to the transferor at a later point of time, then you can say the benefits, then you can say the asset hasn't been transferred wholly to the beneficiary. Even if a part of the asset is transferred to the beneficiary, then also the clubbing provisions will continue to apply. Here we can say part of the benefit from the trust is going to the transferor. In such a case also clubbing provisions will apply, and any income from such an asset will be taxed in the hands of the transferor. So the crux of the situation is there shouldn't be a retransfer of the benefit to the transferor, and even a part of the benefit, if it is transferred, then it will be assumed that whole of the benefit is of the transferor, and such whole of the benefit will be taxed in the hands of the transferor. Here we are talking about benefit. You can say, suppose funds of the asset, funds of the trust are deposited in a fixed deposit account and you have interest income from the same. So you can say there is a benefit from the trust funds, and in whose hands the amount will be taxable depends upon the revocability, irrevocability of the transfer, depends on whether any part of the benefit is flowing to the transferor or not. If also any part of the benefit is flowing, then it will be assumed that entire amount is income of the transferor, entire amount, entire interest income is part, is the income of the transferor, and it will be taxed in the hands of the transferor. So even part of the benefit, if transferred to transferor, then it will be taxed in the hands of the transferor. It in any way gives the transferor a right to reassume power directly or indirectly over the whole or any part of the income or assets. Same, he should not be reassuming any power on such a property, whether whole or partly, whether wholly or partly. So a transfer shall be deemed to be revocable in such a situation. Transfer includes any settlement, trust, covenant, agreement, or arrangement. So friends, section 60, 61, 62 and 63 is nothing but asset transfer, assets which are transferred for the purpose of beneficiary should be transferred without any clause of revocability, should be transferred with an object of irrevocable clause, and no benefit should flow to the SSC to the transferor directly or indirectly. If any part of the benefit is indeed flowing to the transferor, in such a case, whole of the income will be taxed in the hands of the transferor. This is what has been specified from section 60 to section 63, friends, and which also provides a general background of the applicability of the clubbing provisions. So friends, this concludes this subtopic. In the next topic, I will be discussing about section 54. We'll be discussing about section 64, wherein assets transferred to spouse, to minor child, to an HUF. To HUF, how the taxability will be determined, we shall be discussing that.